Hello and welcome to another weekly review. My name is Grant Collins. I'm an independent economist with AIM Research. And in today's video, I want to give you the data that came out last week and highlight the data that's going to be coming out this week to help you get ready for what changes could come along the way, as well as get you ready for what the market may react to throughout the rest of the month here. Now, the data that came out last week was very light. It was mostly data around the housing market, specifically building permits, housing starts, existing home sale data. It's important that we look at this because everybody is, including Jerome Powell, has been saying that housing might be bottoming. And if it's bottoming, well, that's going to provide a catalyst to economic growth because we know that fixed residential investments have been dragging on total GDP, and it's been detracting from growth. So if you actually have a housing market that's bottoming, if you actually have a recovery taking place in the housing market, then you're going to get to see some economic activity increase from that particular sector. And it should be a net addition to economic growth. We're going to take a look at that as well by looking at some forward indicators, some forecasts from the Atlanta Fed, from the St. Louis Fed, and one you may not look at, but I think you should, which is the OECD leading economic weekly tracker of GDP, which I think is really interesting as well. So we're going to point out all of that in today's video, as well as the data that's coming out this week. So let's jump in. Let me show you some charts. Let me get you updated on all of the data that came out this week, and let's get started here. So let's start with building permits, housing starts, and just total completion data. Let me just first read you the numbers that came in. Building permits, surprise to the upside, came in at 1.491 million. Compared to the prior month at 1.417 million, compared to the forecasted estimate of 1.423 million. It's important because we did see a large acceleration in building permits. It wasn't just there, though. Housing starts also surprised to the upside. Housing starts came in at 1.631 million compared to the 1.4 million both forecasted and prior. The other thing is we saw it broaden out, and you're going to see this below here. Let's scroll down. So here is total housing starts. Housing starts, of course, you can see the sharp acceleration and the counter trend move. So we were directionally lower and we were starting this little bottoming process, and now we've jumped above. This counter trend move is so important for what it means to GDP, and we're going to talk about that in a second. But we know that it's been isolated to the multifamily units. But this particular report broadened out to the single families. So let's scroll down here. Here's the single family starts. Look at this increase in acceleration in single family starts. Very positive move there. Let's come down a little bit further to multifamily. Multifamily just continued to move higher and continued to trend sideways here. So that's what I mean by it was really isolated to single family, a unit that was mostly struggling coming into this report. You started to see some really positives here. Now, I want to put some air quotes around this because this data is before the Fed raised interest rate, or I'm sorry, before the Fed telegraphed raising interest rates 2 more times. Is there an element of, hey, let's get this home built, let's get this off the ground, let's lock in these rates before they go any higher? Could be. It's probably too early to tell that right now since the data is lagging by a month. But still, there could be an element of that happening in the background here, as maybe home buyers might be fearing additional rate hikes and they want to get in while the affordability is still within reach. Let's keep moving down, and you're going to see the actual permits themselves. So let me get past completions here for just a second. Here's building permits. Building permits did not accelerate as much as housing starts did. So all these permits were already in the pipeline, and here's this completion. The completion rate still looks really good, right? So homes are getting finished and getting built. The permits, however, have slowed down, even though you have seen kind of an upward move, and that's where the cycle component comes in, as even though you're seeing it moving sideways on a level perspective, it is trending higher on a cycle perspective. Let's break it down to single family and multifamily. Here's single family. Again, permits in the single family home construction market really accelerating here. In fact, coming back above trend. And again, I'm calling it a counter trend move. Here's the multifamily building permits straight down. So it's a handoff, right? They were building and manufacturing a lot of apartments and asking for a lot of building permits for apartments. They're working on those and completing those, right? That's why this completion chart, one more up here, I think looks eerily similar to the multifamily cycle here. So that's one thing to note. Again, the other thing is that even on the building permit side, it's single family, not multifamily in this report. That's a good thing though, because that's a broadening out. If you're looking at the broadening of financial markets and you're only seeing technology, communications, and discretionary, we've been talking about how we want to broaden that out so that way the whole stock market goes up. Well, we need a broadening of the economic data too. And the fact that building permits have moved away and housing starts have moved away from just multifamily and started to come back online for single families, I think it's a really good sign that, hey, maybe housing is starting to recover here. Why is that important? Why is it important for housing to recover? Well, primarily because of GDP. So we know from the Atlanta Fed forecast and from previous GDP releases that housing starts, building permits, and residential fixed investments were detracting from economic growth and creating some negative momentum in economic growth. Well, if you start to have some stabilization and some acceleration of building permits, housing starts, which ultimately feed into residential fixed investment, then you're likely going to see that feed into the GDP number, and you're going to get GDP higher from here. You've seen it primarily mostly in the Atlanta Fed Nowcast, which is what you're seeing here. Let me move this mouse here for just a second. The Atlanta Fed Nowcast is in yellow. The St. Louis Surprise Index is in blue. And then the composite or the combined of those two is in the dashed black line that you're seeing there. So what you're seeing here is the GDP nowcast from Atlanta is at 1.9%. And they were increasing their estimates based on those housing starts and building permits and acceleration. The other thing that we've seen is, despite that, there have been some negative surprises on some of the headlines. And St. Louis, the way that they calculate their nowcast is on a surprise perspective, whether or not the data comes in at expectations, above expectations, or below expectations. It seems like the data that St. Louis is measuring is mostly coming in below expectations. And so when you combine the two, you're probably looking at a 0.8% growth rate for the second quarter of this year. Now, let's move away from that and into another GDP tracker, which is the OECD weekly GDP tracker for the US. They actually do it for every major country, so feel free to jump in here and look at others. But they have the weekly GDP growth rate growing at 1.8%, which is exactly on trend. Again, that kind of fits with our framework that, Jerome Powell wants the economy below trend, and that below trend growth will bring balance to supply and demand market and the labor market. And he can also bring down inflation all at the same time. It's important for us to look at it and frame it from that perspective, because again, if building permits and housing starts, if the housing market is bottoming, then you're going to have positive numbers kind of showing up on the GDP side, all because residential fixed investments is improving. Now, residential fixed investments, we know, is not everything to GDP, but it can certainly help whenever it's been a net negative number that's been calculated in that category for GDP going forward for the last couple quarters here. So if it turns positive, GDP can actually have some momentum to it. Now let's look at some more home data. Let's look at existing home sale data. So you just saw building permits and housing starts surprise to the upside. How about existing home sales? You're going to get new home sale data this week. So let's see what new home sales data looks like. Existing home sale data actually came in just a little bit better than expected. We were at 4.28 million on the prior month. You're now seeing on the chart here 4.3 million homes. So just a few homes have sold here over a month to month. You can see this flatlining in existing home sales. It has accelerated since probably about 6-7 months ago, but it has stabilized here a little bit. One of the things that was really interesting to me is inventory rising a little bit here, and also 3 months worth of supply of inventories on the marketplace here. What that's doing, since that's such a low level, that's keeping home prices elevated, in my opinion. That's also what I'm hearing anecdotally from my local realtors in our area. The fact that inventory is really low, the fact that people locked in, say, a sub 4% interest rate, they don't really have an incentive to sell their home or their property at this time. What that's doing is, for the buyers that are looking out there, it's creating this bidding war on the limited inventory that's available. And so it's keeping a floor underneath home prices right now. That's at least the way that I'm viewing it. So this reacceleration that you're seeing in existing home sales, I think, is a combination of that low inventory story, but then also at the same time, somewhat of a demand story for housing. I really want to see the new home sale data that's going to come out later on. One, because it's a longer time series, so we can actually look at it on a much different perspective than the existing home sale data. And I think it does a really good job of tracking housing starts and building permits and completions. Something I called out the last time is the single family completion rate. You can see how that's kind of moved up and to the right, but actually the sale of those properties have continued to drop. So that tells me that there's some homes that are sitting empty that are brand new, available for people to buy if they really wanted it to. Of course, here's just a real quick 30-year mortgage is setting at 6.7%. And here's that proxy for affordability. Take this with a grain of salt because it's old data. It is off of the new home median sale price. And so we are waiting for that price to come in before this updates, but roughly $2,800 a month for a 30-year mortgage on a $421,000 property. So to me, it seems like in the existing home sale data that, yes, sales picked up a little bit. We've been seeing that in the mortgage application over the last 4 weeks, that those have accelerated slightly, not a lot, slightly. And so again, that continues to make the case that housing could be bottoming. That's again why I highlighted the GDP estimates, because they should be getting a positive revision because of the residential fixed investment component. Last thing I'll highlight before we get into the data that's coming out this week is the initial jobless claims data. The initial jobless claims data actually held exactly the same. It was 262,000 prior week. They revised that up to 264. And then this week also came out at 264,000. So again, a pretty good increase there. What was interesting to me, however, was that you saw a reduction in continued claims. So in April, just a few months ago, continued claims were at 1.8 million. They're now down to 1.759. So you've got initial jobless claims rising, but you've got continued claims falling. Remember, continued claims is those people continuing to file for benefits and continuing to receive benefits. If those diverge, what does that tell you? Well, that tells you that, hey, people are getting laid off, they're filing for unemployment, but then they're finding another job. So they no longer need to continuously file. It's important. It's very, very important, because everybody is talking about the labor market being a lagging indicator. This is our best forward measure, in my opinion, your continued claims versus your initial claims. If they're both rising together, you're in a pretty weak labor market. This divergence that we've seen over the last 2 months, we have to look at that. We have to pay attention to that. The reason why I think it's so important is if you continue to have short-term claims spike, but then continued claims fall, then we can continue to say the labor market is healthy, it's tight, there's more demand than there is supply, so forth and so on. I still stand by the labor market is weakening and it's losing momentum as far as job creation goes. But that doesn't mean that, job openings can still be high and these people that lose their job can still find some work. It's a really positive sign to the economy, and it's starting to give some credibility to the Fed. If this can persist, if this can continue here, then the Fed has found a way to raise interest rates, slow the economy down, bring inflation down without the large loss of jobs that they were expecting. We'll see if that happens. Not my base case. Again, if you look at our forecast, we were expecting the unemployment rate to rise to 4.5%. But it's an interesting development. It's an interesting divergence, not only in this chart, but also in what I was expecting as well. You can look at the Sham rule, and the Kansas City Fed is not yet updated. So we will bring you an update here. This is a good visual of why I think the employment cycle is losing momentum, is because it's deeply below trend, deeply negative as well there. So what else do I have for you? Just real quickly, there were a couple manufacturing reports, specifically the Kansas City Fed manufacturing and the Chicago Fed national activity. Both of those declined, so they continue to show and highlight a manufacturing sector that's spinning its wheels. I don't think it's as deeply negative as it was before, but of course, we're going to get the Dallas Fed manufacturing survey data this week. We've already seen the divergence between New York and Philadelphia. I like to get Dallas in to kind of calibrate all three of them to give me a better indicator to go off of. And as soon as we have that next week, I'll give you that as well. The other thing that we got was the Conference Board's leading economic index. I expected that to accelerate after seeing the stock market rise, which is one of the indexes in the Conference Board's leading index, and the building permits and housing starts rose. And so the combination of those two, I thought the number was going to come in better than expected. It actually came in worse. In fact, the Conference Board's leading index came in at -0.7 versus -0.6. Now, why did it come in worse? It came in worse because of the financials, the credit spreads, the yield curve. Those numbers played a higher percentage or a higher weighting to the overall index than maybe the housing starts, building permits, and the stock market did. The other thing that we saw was just a flatlining of things like durable goods and retail sales. And so those were some other things that kept the Conference Board's leading index from moving too much higher. That was a complete shock to me. I expected it to move higher and it didn't. It's another sign that the economy is in this kind of economic malaise and that it's going to be growing below trend. Growing, I think, is the key word here, but it's just going to be doing it at a very, very slow pace. Now, what data is coming out this week? Let me look at my notes here. You're going to get the Dallas Fed Manufacturing Index today. You're going to get durable goods orders, another housing data, Case-Shiller Home Price Index. I'd like to see Case-Shiller start to trend sideways or turn positive here, matching what we're seeing out of existing home sale data, out of new home sale data. If Case-Shiller keeps coming down, then that does kind of put some pressure on this recovery that you're seeing in some of the housing market indicators. What else are you going to get? You're going to get new home sales. You're going to get mortgage applications, the balance of trade report, wholesale inventories, initial jobless claims. You're going to end the week with the final GDP revision from the previous quarter, as well as getting personal income, personal spending, personal consumption. And then you're going to end the week with an inflation report, the PCE price index, which I think will continue to moderate, like we've been seeing from the prices paid index, from manufacturing's data coming from the Fed, like we've seen from the PPI, and like we saw from the CPI. Core will probably remain sticky, but I expect headline to continue to soften here as we go along the way. And we're going to have to wait and see what the June data holds, whether or not we get a continued slowdown from here in inflation or whether it starts to remain somewhat sticky. I think it's really interesting to see the Fed go ahead and telegraph and say that they're going to raise rates 2 more times, but yet skip a meeting. Well, why not go ahead and raise if you really want to raise? That tells me that they're uncertain. That tells me that it wasn't a unanimous vote, that maybe some of the committee members thought that they should be pausing altogether, while some of them felt like they continued to need to hike here. And so pausing was maybe a way to save face and allow everybody to be on the same page moving into this coming up meeting that's happening here in July. So again, lots of data coming out this week that's going to continue to help orient our decision making. What does it all mean for the market? Well, the market did finally sell off a little bit here as they've been trying to reprice the fact that 2 more interest rate hikes are coming. I think I mentioned this on our last weekly call, that the market at current pricing at the 4,400 range was pretty much pricing in the analyst expectations for earnings. So if you were buying at the 4,400 level, you were expecting the company earnings that the current analysts were thinking. And so to me, that is very important from a level perspective to say, okay, if company earnings come in right as expected, then the market's probably going to hang out around the 4,300 range. If they come in better than expected, then we can see some positive float higher from here. Right now, FactSet just released their report on the 23rd, and they have the second quarter earnings estimate at -6.5. So they think it's really going to decelerate. So you do need it to come in a little bit better than that for the market to surprise higher and continue to have some upward momentum. I think we continue to trade in this range bound and maybe even come back into my 4,200 range that I was looking at. But if the company earnings continue to surprise to the upside, then my band is going to have to widen to somewhere between like 4,400 and 5,000, somewhere in that range, if and only if company earnings come in on the upside. That's what I'm looking at next. It seems like the economy, again, is going to be in kind of a malaise here and just grow sideways and continue to have below trend growth, so below that 1.8%. We're going to need to continue to see that inflation rate come down, so that way we continue this progress we've already been experiencing here. With that, I got a little long-winded here for such a short amount of data that came out this week. If you have any questions at all, don't hesitate to leave me a comment below or shoot me an email. Happy to answer those for you. If you like these videos, please like and subscribe to them. YouTube likes it and really appreciates it when you do that. And I will be back again next week with another update.